Real Estate Banking. Interest Rates by Albert Del Toral. Interest rates play a major role in our economies and our daily lives. It is a topic of concern for investors because interest rates determine the feasibility of borrowing money, and most investors depend on credit. While mortgage interest rates have been near historic lows for the past 3 years, economists feel that rates are working their way upward. Finding the current interest rate is simple enough, but understanding and predicting rate changes is trickier and infinitely more important in developing a borrowing strategy. Using a simple overview, it is safe to say that lower interest rates stimulate economic activity by lowering the cost of borrowing, which makes it easier to buy and build. Higher interest rates, conversely, slow the economy by increasing borrowing costs, thus discouraging growth. Serious investors, however, need to delve a little deeper to understand the fluctuations in the interest rates that govern real estate loans, savings accounts, and stocks and bonds. Wise investments depend on foreseen market trends in order to minimize risk. Interest rates on residential mortgages and U.S. Treasury securities are influenced by trend changes in economic indicators, such as the gross domestic product, the consumer and product price indexes, and other consumer credit data, including employment rates and housing starts. Rises in inflation signal raises in the prime rate that, in turn, signal increases in credit interest rates, including mortgages. The most important indicator leading interest rate changes is the report on gross domestic product, or the GDP, which indicates the total amount spent on goods and services produced in the United States. An increase in GDP signals a rise in inflation and generates a response by the government to raise interest rates in an effort to curtail inflation. Conversely, a response to a low GDP would be lower interest rates to stimulate growth. The government also uses the Consumer Price Index, or CPI, and the Producer Price Index, or PPI, which measure price changes to monitor inflation. In June, the Consumer Price Index rose 0.2%, and inflation was reported at 4.7% for the first half of the year. These indicators led to adjustments to the prime rate, which is the interest rate charged by lenders to borrowers considered most creditworthy. The prime rate is used to calculate mortgages and other variable loans. Investors tracking mortgage loan interest rates should also keep a sharp eye on housing starts. A higher than expected increase in housing starts triggers economic growth and is considered inflationary. When there is an increase in housing starts, the Federal Reserve's response is to raise the prime rate to slow the economy. Prime rate increases signal increases in the mortgage lending rates that banks and loaning institutions can offer. Variable interest rates are specified as the prime rate plus a fixed value. While the Federal Reserve, the central banking system of the United States, has lowered the prime rate several times over the past few years, it is now on an upswing. Fixed mortgage rates have increased a little more than 0.5% since the beginning of 2006, with half of that, or 0.25%, occurring just in the month of June. Economists predict that interest rates will continue to rise at a faster rate than they have so far this year. Thus, lock-in rates as opposed to variable rates are encouraged at this time. Though rates are still higher than they have been in more than 4 years, they are still pretty reasonable. Michael Reich, an accountant, independent realtor, and day trader in Pembroke Pines, Florida, suggests that if you are going to buy a house, buy now, because even though the housing market may slow down, rising interest rates will make it harder to purchase and cause inflated monthly payments. He feels buyers are in a catch-22 situation. The Federal Reserve Board has been gradually raising short-term interest rates during the past 3 years. A 30-year fixed-rate loan cost just 5.27% in June of 2003 and 5.84% in June of 2005. Freddie Mac, the Federal Home Loan Mortgage Corporation, reported that the average interest rates on a 30-year fixed-rate loan was 6.78% at the end of June of 2006. Although interest rates have increased 17 times, 0.25 point at a time, since June of 2004, the current rate is only a little more than 1.5 points higher than the record low reached 3 years ago and, fortunately, has not reached the double-digit rates of the 1980s. Introductory rates for adjustable rate mortgages, or ARMs, are rising even faster, averaging 6.1%, up from last year's 4.8%. When asked about the changes in interest rates, realtor Samantha Millis, who believes rates will continue to increase, said,
"Anyone buying a home or making adjustable rate mortgage or credit card payments will feel the effect. Energy prices will probably also have an impact on increasing interest rates."
So, how does this affect your wallet? Imagine that you bought a $250,000 home at today's current 30-year fixed interest rate of 6.78% versus the same home at 7.5%. With the lower rate, you would be paying $1,626.48 monthly, not including insurance and taxes, versus $1,748.04 at the higher rate. Over the life of the loan, you would have paid an additional $43,761.60 in interest alone. Tracking interest rates and buying when rates are most favorable is an essential part of making wise real estate investments. In tracking interest rates, it is most important to keep an eye on the workings of the Federal Reserve System and its new chairman, Ben Bernanke, successor to Alan Greenspan. While no one knows for sure, Fed watchers predict that there will be additional 0.25% increases with each Federal Reserve Board meeting. Since interest rates are directly related to inflation, it would also be wise to keep an eye on inflation, which rose from 3.4% in 2003 to 4.7% in the first 6 months of 2006. If the Federal Reserve imposes another 0.25% increase on the nation's banks, we would expect mortgage rates to top out at around 7.1 to 7.2% by the end of the year. So, what is a buyer to do? The best advice is to keep informed of the latest economic developments in the country and around the world. The global economy, inflation, trade patterns, and even politics play important roles in interest rate predictions.